Home sales have stayed a little sluggish nationally into August. Mortgage rates have climbed 30 basis points starting in July to roughly the highest levels of the year. The economic and geopolitical news hasn't been terrible, but it hasn't been good enough to really spur the bond market. So the inflation data last week was a little improved in July over June, but inflation is still too high for policymakers. Initial unemployment claims are really low, which implies the labor market is not weakening notably. That means that policymakers don't have to cut rates to help jobs. We have persistent challenges in the Middle East. All in all, these are not conditions favorable for improving interest rates. So even though the 30-year fixed rate has been ticking slightly lower for a couple of weeks, the cost of money now is higher than it was last year in August. Last year, mortgage rates were in the early stages of a 7-month march lower. So in August, rates were past the peak and moving lower. Now the opposite trend is underway. So it's no surprise that homebuyer demand has slowed in comparison. Q2 this year showed nice home sales growth over Q2 2025. Q3 so far is not holding up as well. These demand shifts are measurable in other metrics that we track too. So I like the Xactus Mortgage Intent Index, which counts the credit pulls for people getting a new mortgage. This indicator also includes refinances, so it's not just purchases, but it's 10% fewer than it was a year ago. The Mortgage Bankers Association releases their Purchase Mortgage Index, and that one has been 1% to 2% below last year's pace. So all three of these measures of housing demand are sliding lower and haven't seen a bottom yet. That implies the sales rate for August are probably going to come in negative when we see the data in September. So if you're paying attention, you know my rule of thumb for rising interest rates means rising inventory. The supply of homes for sale on the market ticked up by 0.5% this week. That's normal for mid-August. There are just over 1.1 million homes on the market currently. That's 1.5% more than a year ago. So we can see that inventory is building just a little bit over the last month as mortgage rates climbed. As demand slows, inventory grows. So let's look at the data for the week and see where we stand as of mid-August 2026. Let's start with data today looking at the weekly pending home sales. The new pending contracts came in a little bit under last year's pace, 77,000 new contracts this week. That was 3.9% fewer than the same week a year prior. Most weeks this year have seen more sales than the same week in 2025. For the first week of February, that after those big winter storms shut down half the country, that was a 5% negative week. In terms of year-over-year comparison, that was the weakest period of the year. Now is our second weakest. So the momentum is slower now, and that's worth paying attention to. As a result, this month's sales pace has slid to just about 1% fewer than a year ago period. It's very close to unchanged, but just slight moves up or down year to date. Though we've counted about 3% more sales contracts than the same period last year. So when we started 2026, our forecast was for 4% growth over 2025. So the growth is currently just under that pace a bit. So we'll see how the final 4 months of the year shape up. In this chart here, I have the recent 4-week rolling average, which is now 81,000 new contracts per week. You can see the blue line here, which has been safely above last year's purple line for the second quarter. That expansion is now gone. They're about the same level as a year ago. Last year in August, we'd shifted to a period of declining mortgage rates and slightly accelerating demand. That momentum is actually opposite right now. On the supply side of the market, there are 1.1 million homes on the market now. That's up 0.5% for the week and is 1.4% more than last year at this time. Inventory relative to last year is inching higher. So I mentioned my rule of thumb. As rates rise, inventory rises. As demand slows, inventory grows. So this is because demand shifts faster than supply. In other words, it's much easier for a potential buyer to not make an offer when affordability slides out of reach than it is for a seller to back off sales plans. So demand improves faster than supply on the other side too. So inventory falls as rates fall. As it gets more affordable to buy, more of us buy. It's funny, but this is not always intuitive to market observers. There are, more home buyers waiting on the sidelines until rates fall again. And that may be a valid path for them. However, what they probably don't realize is that as rates fall, there are lots of other potential buyers waiting too. So the competition increases and the selection declines. In supply-starved regions in the country, like the Midwest, this could be a very important lesson. Buyers have faced just a crisis shortage of available homes. That has pushed prices higher and has kept a lid on the total sales volume. Buyers who are waiting for rates to drop and for more inventory are unlikely to get both, unfortunately. In this chart, we have the recent inventory trends. Each line is a year. There are 1.1 million homes on the market now. That includes single-family condos and townhouses. The blue line here is just barely above last year at this time. I included also the 2017 line here in gray. Nationally, there are 10 or 15% fewer homes for sale now than there were in 2017. If rates were to shoot higher from here, say over 7%, then I'd expect inventory would climb much closer to those old normal levels. But as of now, we expect inventory to remain just above the 2025 levels for the rest of the year. I've been recommending to pay attention to price cuts in August, so let's make sure we do so. Price reductions moved higher again this week by 30 basis points. There are still slightly fewer homes on the market this year with price cuts than last year at this time, but at this pace, looks like we will overtake last year sometime in September. So is currently about 41.7% of the homes on the market have taken a price cut from the original list price. In this chart, again, each line is a year. Notice the blue line is still marching higher. That's a market shift underway. The yellow line is 2023, and it shows a September spike in mortgage rates that really slowed the demand. You can see that up angle in the yellow line in September of 2023. It is important to note that we're actually not looking at that right now. We're not experiencing that same shift right now. This is a gradual slowing. The marginal demand weakness is happening stepped rather than a big shift. I like to point out that consumers are more sensitive to changes in rates than to absolute levels. So rates have moved up 70 basis points in 5 months, from 6% in February to 6.7% now. In September 2023, that jump happened in 1 month. The change was really dramatic. So that change in rates hit demand much harder than the slow change we're seeing now. We are witnessing the pinch of affordability, of course. But this shift is much more subtle. Home prices remain very stable. The median price for single-family homes in the country is $399,000 right now. That's essentially unchanged from last year. In all the home price data, whether you're looking at the median sales price, median pending prices here, whether you're looking at the Case-Shiller index, there just isn't a lot of movement in home prices. if you're in tight inventory markets like Chicago, home prices are above last year at this time. Most of the country is flat. Some areas, home prices are below last year by a few percent. Las Vegas and Seattle are two markets on the negative side by a couple percent with home prices versus 2025. So it's kind of unexciting to report on home prices because they're very stable, but this is likely to be the case for the foreseeable future. Interestingly, I expected that we would see negative home prices in the headlines sometime this year, but that hasn't happened. There are enough markets with very tight supply that are keeping the national average of home prices up year over year. Add into that several markets that have had notable recoveries this year. I'm thinking about San Francisco and Miami. Those are metros where home prices were falling and are now back to appreciating versus last year. So local markets tell the detailed story, of course. Some are up, some are down. But nationally, home prices are very stable compared to recent years. There isn't any signal I can find in the data that moves the needle in either direction. So we'll keep watching, of course, and more next week. See you then.